credit spreads, this is why we invest in them. This is why our company has been investing in corporate bonds for 50, 60 years, probably. They almost always overcompensate you for default risk.
This episode is made possible by Progressive Equity Research, providing freely available, engaging investment research and opportunities to hear from a wide range of small and mid-cap UK-listed companies. For this episode, I'm joined by Jim Leaviss, one of the UK's leading bond fund managers and the voice behind the podcast Uncle Jim's World of Bonds. I subscribe to a lot of podcasts, but there aren't many that I always listen to. However, Uncle Jim's World of Bonds is always a must-listen for me. It's both entertaining and informative. It is typically just 10 minutes long and contains some real nuggets covering macroeconomics, financial markets, politics, and the long-term drivers impacting the world all investors inhabit. We recorded this chat on July 1st, and quite a lot has happened since then. Obviously, we've had elections in the UK and in France, and the advancement of England and France to the semi-finals of Euro 24. In this episode, Jim covers why he thinks bonds are so interesting and important, and what we as investors can learn from them. He covers Trussonomics, the implications of French political instability, the potential impact of an unwinding of Japan's carry trade, and what to know about credit spreads and how it might inform equity markets. Jim has been at fund manager M&G for 27 years, most recently as CIO for fixed income. Since we recorded this episode, Jim has announced his departure later this year to study the history of art. I very much hope he can also find time to keep up his podcasting, maybe interspersing yield curve analysis with a view on the modern relevance of German expressionism from the interwar period. I must also remind you that none of what you hear is investment advice. It is all just the personal views of the people talking and does not represent the views of any organisation mentioned in this podcast. So please enjoy my conversation with Uncle Jim about his world of bonds.
Brought to you by Progressive Equity.
So Jim, thanks for joining us today. Can we just start at the beginning? What got you into this world of bonds?
I did economics at university, but this was at a time when I knew absolutely nothing about the city. But I've never heard of fund management, never heard of anything like that. But of about the 3 jobs that I applied for in what was an awful jobs market back in the start of the 90s, I think one was W.H. Smith, one was the civil servant training scheme, and the only one that offered me a job was the Bank of England. So I ended up there.
You must have been pretty mathematically inclined, pretty quantitatively driven. Were you looking at bonds when you were at the Bank of England?
I was, to be fair. I would never say I'm particularly mathematical, though. I'm not afraid of maths, and I don't think anyone, you have to do your what's now the CFA and things like that. In my day, it was called something different, but you do have to know some maths to be in bond markets. We are a lot cleverer than our equity brethren, in that regard. It's not just about how good a chap the CEO is and all of that sort of stuff. We actually do get our bond calculators out from time to time, but you don't have to be Rain Man level quantitative to be a fund manager. The most important thing is understanding big numbers and the quantum of them, understanding what sounds sensible, what sounds plausible.
So it's not just about understanding nice stories and buying into the ones you like then, like us equity chaps have been doing over the years.
Yeah, and we don't go and look at the new invention and decide that we're going to have 5% of our fund in it. But, of course, there are narratives in bond markets just as there are in equities. And so there are lots of models and stuff, but no model survives more than one economic cycle before it doesn't work. And then everyone comes up with a new model to explain everything. One of my colleagues at the moment is going back to monetarism to explain what's going on with inflation. But as you know, and your listeners will know, monetarism went out of fashion for probably 3 decades post Lawson and Thatcher. You could argue that that was a mistake, that people stopped focusing on it. But, things come and go as big drivers for the bond markets.
Whereas I think people like Tim Congdon would say that we ignore the monetary aggregates at our peril. And he, among other people, have been criticising your former employer, the Bank of England, about the diversity of thought on their monetary policy committee.
I have a lot of sympathy with central bankers at the moment, or rather their post-COVID experience. I mean, the word transitory was one that comes up time and time again, that central bankers thought inflation was transitory. I don't know what the answer is to this. Obviously, they did get it a bit wrong with hindsight, but what are you meant to do? Suddenly, you have a price shock that sends the cost of groceries and energy up by, let's call it 20%. What are you meant to do? That's just pain for consumers. That's pain for households. Are you really meant to, at the same time as that, put their mortgage rates up by 200 basis points, 300 basis points, so they've got less money left to spend on clothes and going out or other stuff in order to drag the economy down and create deflation in other categories in order to offset the inflation from food and energy caused by war or caused by COVID? And so I think inflation has been transitory. It went up to 11% year on year. It's now down at 2% year on year in the UK. But clearly there were some other factors going on, and counting up the money in the economy is one of those things that is important, but you shouldn't base your whole monetary policy on it, in my view.
One variable, yeah. So from a big picture, tell us about your world of bonds and why it's so interesting, and what can we as general investors learn from it?
The thing that's fascinated me about bonds over the decades I've been in the market is that there's so much going on. It is almost the ultimate test of putting together lots and lots of different pieces of information. And sometimes that's really annoying. And I know this, again, not doing down the equity cohort, but, building a cash flow model for one individual company is all very well. But looking at global government bonds, you have to know geopolitics, you have to know demographic trends, technological developments, monetary policy frameworks, commodity prices, the supply and demand of interest for loans and borrowing. So there's just lots going on, and you can really bring in all your own personal interests. And I always say to people starting off when they say, what should I be reading? And they kind of automatically expect it's The Economist and the FT. And of course, you can't get away from those. I mean, The Economist is, for me, the epitome of concise, good writing. But in terms of learning about the world, probably someone coming into the market would be just as well reading The New Scientist and understanding in the most recent issues, you've got new developments in clean energy and fusion and fission energy, what's going on there, what's going on with pandemic prevention, what's going on with global warming, what that might do for food prices. So there are other things outside of the dry economics, if people think of economics as dry. And, these bookshelves are full of people who can write eloquently behind me about economics and make you interested in the subject. But there is a lot more to what drives bond prices than just simply our central bank putting up rates or putting down rates. So, for instance, the ECB was cutting interest rates just a couple of weeks ago. Bond markets have actually sold off somewhat since then. It's not as simple as being able to forecast what the 9 people on the Bank of England's Monetary Policy Committee are going to do. It's much more interesting than that.
You have to assess how the market's going to react to those moves and what the market has already priced in.
Yeah.
My impression is that bond markets have become more interesting and more relevant to non-bond market specialists, probably in the last few years, since the pandemic and since the burst of inflation that we've had. And I guess in this year, I think we've got 64 elections around the world. It is the year of elections. Feels like it's sort of a defining year for bond markets.
I think you've got 2 big dynamics going on. The first one is that inflation is definitively coming down pretty much everywhere. And that should allow central banks, including the Federal Reserve and the Bank of England, to join the ECB and the Swiss National Bank and the Riksbank and others that have already started cutting. So that's obviously what bond markets have been waiting for the last year and a half, markets have been anticipating the Fed getting ready to cut and regarding that as a signal that this unfortunate inflationary burst is at an end. There's still a very good chance that that is the case. And that's the bull story for fixed income. The other added to the same time as that is that valuations for bonds are as attractive as they've been for a very long time. You can get 6% if you invest in a triple B rated US dollar bond, whereas if you went back a couple of years, you might only be getting 2.5%. So there's been a huge valuation shift, which to your point is one of the reasons why people are interested in bonds again. And positively, interest rates coming down should be good news. At the same time, you mentioned the elections, and it's not just the elections because Labour and the Tories' fiscal policies are likely to be fairly similar in the amount of bond issuance. But longer term, who is out there in terms of the political world willing and talking about the debt burdens that societies face? And this is the big debate. Does the amount of debt that the US has or the UK or the Eurozone have in terms of government bond issuance matter? And Laura Kunsberg got into trouble a couple of days ago talking about the UK debt in terms of the household and saying, has the UK maxed out its credit card? And it's not just her, but politicians, commentators, look and say, we've got too much debt. If this was a household, we'd be going bust by now. And economists would say that doesn't matter. It's a different situation. But even those of us who up to now have said it doesn't matter, it's a different situation, are starting to say, actually, well, Trussonomics was a bit of a wake-up call that whilst governments can, of course, if you're a reserve currency that can print its own currency, carry huge amounts of debt, there comes a point where markets say, that's scaring us, go away, otherwise your bond yields will go through the roof. And, Trumponomics, Trussonomics, as Donald Trump looks more and more likely to become president again, is that something that we should be worried about? And I think the answer is probably yes.
How does the UK come out of all this relative to the rest of your world of bonds? I mean, you started answering your last question by saying the fiscal constraints of Labour and Conservative mean that in the short term, for the foreseeable future, they're unlikely to do very different things fiscally in any significant way, which puts us in quite I'd say, unique place in the world at the moment, particularly when you see what's going on across the Channel and arguably across the Atlantic.
Yeah, but remember, most important thing, and this is something actually Keir Starmer talks about a lot, is growth. The way that any of these countries can get out of their debt problem is to grow. It's how the world got out of its debt problems after World War II. There are other things that can help as well.
Yeah, inflation helps, doesn't it?
Yeah. And that is nominal growth, a mixture of growth and inflation, a bit of financial repression. People buy your bonds at prices too high, effectively, below the rate of inflation. So there are things you can do to de-lever. But growth has been the missing ingredient in the Eurozone and in the UK. So that is going to be the challenge for that block of economies. In the US, they've actually had much better growth, but they also are better at making the false argument that was made famously on a napkin by Laffer about 50 years ago now, or 40 years ago.
He's still with us.
He's still with us, yeah. And that napkin is on display in the Smithsonian Museum. And it basically says that if you cut taxes, actually your growth rate will be so strong that the size of the pie will expand such that although your tax rate is lower, your tax take is higher. And right-wing governments, time and time again, make this claim, but history shows it's never proven to actually happen. The tax take doesn't compensate for lower tax rates, and you end up with debt to GDP expanding. That was the Trussonomics fear, that cutting taxes so aggressively would not create the growth that would be necessary to pay for those tax cuts. And Trumponomics, obviously, that's one leg of what he's talking about, significant tax cuts for rich people and corporations. And I think that the market doesn't really buy that argument, the Laffer curve argument anymore.
But of course, the Americans, Reagan had, with his supply side revolution and Laffer curve economics, got away with it because they have the dollar. Liz Truss didn't get away with it because we don't have the dollar, and we uncovered a bit of a black hole in some of our pension funds at the same time, which caused a bit of a death spiral. So what does explain the superior growth of the US versus the Eurozone and Europe? And from what I can see, it traces back to the global financial crisis, although I think everybody's got their pet theory of when and why this has occurred.
Yeah.
I guess the key question is, how do we recognize sensible policies that stimulate economic growth? Let's start with the UK, given that we're on the cusp of a general election and almost certainly going to get a change of government.
In short, why is the US outperforming the rest of us? 3 reasons. One, Bidenomics, which has been the Inflation Reduction Act. So the US is running a huge budget deficit, which is really unusual at this stage of the cycle. Normally you'd run a budget deficit when you had a growth problem. The US doesn't have a growth problem. It has strong growth, and yet it's still running a budget deficit of 6 or 7% of GDP, mainly as a result of things like the Biden fiscal stimulus through the Inflation Reduction Act. So that's throwing gasoline on what was already relatively robust. Secondly, it's strong because of immigration, both illegal through the southern border coming up through Mexico, and legal. They're more tolerant of legal immigration in the States and have higher birth rates as well, thanks to immigration. That leaves their demographics much more favourable, more people coming into the workforce. If you break down GDP growth and tried to say what are the drivers of it, one is productivity growth, the other is an increase in the working age population. Europe is an old economy with aging demographics and has a shrinking working age population because of immigration. The US has an increasing working age population. That's driving growth. And finally, I'd say it's the wealth effect. People in the UK and Europe do own shares in stocks and shares, ISAs and so forth, but not to the same extent that Americans have embraced Nvidia shares, Facebook shares, Meta. There is much more of a culture in investing in the sexy shares that are the ones that have done really, really well. So you put those 3 things together, Americans feel richer, there's more of them in the workforce, and they've got some gasoline from Joe Biden. And so that's why they're growing more quickly. When it comes to the UK, Labour are going to find themselves in a difficult position if they are elected at the end of the week. But if you look at Rachel Reeves, she's been doing the rounds of fund managers like the one I work for. And we have an infrastructure deficit here in the UK, as most developed markets do. We can spend more money on hospitals, on broadband, on electricity generation, clean energy, transmission networks. There is work to be done there that ends up, reducing our reliance on Russian gas, and also helps our net zero targets and helps generate the growth that we might be looking for. But it's not going to be easy.
So in a sense, it's a watered down UK version of Bidenomics.
Yes, I think so. I think Bidenomics also includes quite a large dollop of industrial policy. And remember, there's a lot of onshoring based on the difficult geopolitical relationship between China and the US, things like semiconductors and advanced technologies. A lot of that is coming back to the US as part of a industrial policy. And industrial policy became a slightly dirty word in the UK over decades, but maybe there is a place for it. Maybe Bidenomics has shown that it can work. But at the same time, Economics 101, free trade is always been regarded as the optimum outcome in terms of economic outcomes. If everyone's building everything in their own countries, that's going to be a bit more inefficient, and there'll be a cost to global growth from that.
One could expect a structurally higher rate of inflation going forward. We being the UK economy is already at target. I think we're probably the first major world economy to reach the magical 2% target. Do you think that 2% is going to become 3% or 2.5% going forward?
I think that's where the battleground will be. You know, the battleground post the global financial crisis was based around central banks struggling to get inflation up from 1 to 2. It was always 1% or 0.5% below target. Maybe the next cycle will be one where central banks are kind of fighting the battle to get inflation down from 3 to 2, and it'll be hovering at 2.25, 2.75 a lot of the time. So yeah, I think there are some upward issues around inflation that central banks are going to have to face. We also have Trump threatening 10% import tariffs at the same time. And obviously that has a big feed through into the prices that US consumers will pay for stuff. And so that could be another factor that leads to structurally higher inflation rates.
You mentioned Trump. We had the meltdown of a TV debate last week. If we do get Trump, how should we think about it, and how do bond markets react? How do financial markets react?
He is likely to inherit a slowing economy. You know, the US have been running hot for a long time. There have been some numbers out today of the kind of purchasing managers indices that have been trending weaker. You know, the economic upward surprises appear to be coming to an end for the US economy, and we're entering a slower growth world there. So he may be inheriting an economy that is slowing down. He may try and reduce that economy. The knee-gut reaction is strong dollar, Fed stronger, although with the risk that Trump interferes with the Fed in some way. He didn't try very hard to remove Powell. Well, he appointed Powell.
He appointed Powell, didn't he?
And then changed his mind about him during his presidency in terms of him not doing quite what he wanted. There is a danger. The mechanics for replacing a Fed chair are quite difficult. Nevertheless, you could find the Fed and the president at war in some way. That's probably not going to be seen as a good thing. But Trump will want lower interest rates and a hot stock market. How do you play that? But obviously, there's an inflation element there that probably means bonds think about this as being not a great environment. And I'd add to that when you look at what the credit rating agencies have said historically, they've pointed to things like political instability in the US as being something that causes them concern. Of course, there may not be any political instability if Trump's got a clean sweep of Congress and House of Representatives, the Senate, the Supreme Court, the presidency. There might not be any instability in quite a way that might worry people, but you won't have those debt ceiling debates and things like that anymore. But there's certainly some credit worthiness issues about that might worry people in terms of the US's standing as this big reserve currency that believes in the rule of law and the institutions. And I think that one of the things that Trussonomics taught us was that institutions matter. And part of the sell-off that we saw in bond markets was around Liz Truss and her team's refusal to allow there to be a Office of Budgetary Responsibility assessment of what her mini budget or fiscal event would mean for government borrowing. So if you kind of try and cut out the controlling institutions in some way, bond markets really don't like that.
By contrast, I think, as you mentioned earlier, Rachel Reeves will be steeped in the necessity for bolstering our institutions. And I mean, she worked at the Bank of England, and I think that it'll be very much a safety first, don't frighten the horses type approach.
I mean, hopefully they don't get too bogged down and come up with fiscal rules because they're so difficult, i.e. don't let your debt to GDP go above a certain thing. Don't let your deficit be here. Golden rules and cyclically adjusted deficits. The markets know what common sense is, and common sense is when you get an event like COVID, you are going to have to break all your rules, or an oil shock or something like that. So let's not tie the hands down too much. But yes, she and the party will have to be more conservative with a small c than they'd like to be.
How should we read yield curves? Does an inverted yield curve always lead to a recession? Is it a useful tool? When's the recession due, or have we already had it?
Well, we had it in the UK very, very briefly, didn't we? The main one that people look at is the US and various measures of what yield curve they'd look at, but generally the 2-year point of the curve and the 10-year point of the US yield curve as we speak now, 2 years at 4.75, 10 years at 4.5. So, you still do have inversion in the US yield curve. Up to now, it's been a 100% correct indicator, forward-looking indicator of the fact you're going to get a recession. If you look back at history, when 2s, 10s inverts, you generally get a recession 6 to 18 months after that. This time round, it hasn't transpired that we've had one. For those reasons we talked about, we avoided a recession by doing a huge fiscal stimulus effectively.
We did it or just delayed it?
I mean, we will get a recession one day. I mean, on average, recessions come every 7 years. And so we're due one. We shouldn't always regard recessions as a failure of government policy. And, actually, that's an interesting point, that some people argue that the slow growth rates that we see in the UK and in the Eurozone in particular are a result of not allowing recessions, that every time something bad happens, central bankers ride to the rescue and bail out the banks and bail out investors or do a fiscal stimulus or do quantitative easing or bail out the Italian government, Greek government, whatever it may be. And there is an argument in this new world, post-global financial crisis, where every time there's a stutter in the economy, we get a bailout. That doesn't allow the creative destruction that is really difficult. As a bond investor, I would never want to say, we need to close down all these factories and make way for more efficient stuff. It's never a nice thing to consider what the individual impacts are on human beings. But if you were purely utilitarian and thinking, well, these people might lose their jobs, but actually that makes way. The bad, huge factory complex in Germany closes down, but the 3 little competitors that can't make money while that factory is borrowing money at minus 0.1%, suddenly they can make money because they're not competing against an incumbent that's got no cost of capital. And so there is this argument that you do need to allow some downside risk into your economy, and we haven't really had that for a while.
It comes back to your point earlier about the wealth effect in the US. I mean, that's born of a culture and a propensity to assume risk and build capital, but take the hit as well. I mean, it's much easier to go bust and much less social stigma attached to it in the US than it is in the UK and in the old world in Europe.
Yeah, I mean, Trump's gone bankrupt, I believe, at least once, hasn't he? I don't know how many times.
He's probably never been solvent. The second question was on credit spreads. I guess credit, there's sovereign bonds, then you've got to understand duration, and then you've got to understand credit. And then you're one step away from some form of equity. You're taking risk, some sort of form of solvency risk. How accurate are credit spreads, and what can we as equity investors learn from understanding and getting a guide from how credit spreads work?
There are lots of examples over the past few years where bond markets and bond yields have told people about what's going on in corporate world, but there've been just as many instances where, our credit people every day will be looking at the equity price as well to see, is that going to be a guide to the company's solvency and credit worthiness? So it works both ways. Credit spreads, this is why we invest in them. This is why our company has been investing in corporate bonds for 50, 60 years, probably. They almost always overcompensate you for default risk. You get paid too much relative to a government bond. You can look at the credit spread. Let's think about a triple B rated company, might be an industrial manufacturing company or a supermarket or something. Let's say it has a credit spread of 125 basis points. You can come up with a calculation that says, well, when a company goes bust, we normally get back 40p in the pound. That's typical for a bond investor in the event of a default. And you can say, well, looking at that spread over the next 5 years, what kind of default rate does that imply? And we compare the default rate that's implied in the corporate bond credit spread with what we've experienced historically from similar rated bonds. And then we look at some really bad periods. Say, well, what happened to similar rated bonds in the GFC, just in case that's coming round the corner? The answer is that for investment grade bonds, at least, you almost always get overcompensated. You get paid too much spread. The movements, when something gets into difficulty, the spreads do widen. You can follow that and come up with a view that might be helpful to equity investors. But as I say, probably the equity is also tanking at that point.
The equity market does know something.
Yeah, we'll give it a small amount of credit, but yeah.
We've just had the first round of elections in France yesterday. It seems most likely that we're going to get some form of technocratic government, and the market seems to like that. How do you see this sort of playing out? Are we heading for another euro crisis that could be on a similar scale to 2014?
I think it's probably too early to start panicking about Europe, but obviously the Le Pen party is Eurosceptic. I mean, it hasn't talked about Frexit for a while. So if you went back to the last presidential elections, there was more noise from the RN around taking France out of the European Union. But that's not popular within France. No. RN itself got 33% of the vote, but even within that 33%, most people would say, actually, France has done okay out of being a European Union member. So I think that it's not going to be helpful for European cohesion, but it doesn't spell Eurozone crisis part 2 or whatever part you want to say it is. So it's a worry about things like, can Europe be a cohesive force in a world where geopolitical tensions are higher? What does this mean for Poland and other people on the border with Russia who might be thinking now is the time that we use EU bonds to finance higher levels of defence spending? We start thinking about coordinated defence and so forth. So at a time of increased geopolitical tension, it's not necessarily helpful for Europe to be splitting in these disparate directions. But, it's telling you something about the rise of populism, and who next is the question, right?
I mean, Italy is an interesting case in point. I mean, they've had their period of technocratic regime change, and then we had the rise of the far right. And all of a sudden, she's the most secure politician in Western Europe right now, and she seems to be playing quite well in the tent.
Yeah, she doesn't seem to have implemented the fears of people in terms of how far right she would be. She's been constructive. She turns up at EU summits and is, as you say, not trying to disrupt it. It's not like, I can't remember what that guy, but wasn't there someone before her, the Seven Stars? I can't remember what they were called now, but there was a
I think you're absolutely,
his name, and he was far more break it all down.
Yes.
Once again, she's behaving in a political way, like a traditional politician, and that's allowed people to relax somewhat about her position.
What's going on in Japan? Should we be worried? It's got very low interest rates. It's got the weakest currency of any major economy year to date or over the last couple of years. Is it where we're all going? We were talking about the high levels of government debt to GDP and the trajectory that we being the Western world, all seem to be on. Are we all going to be turning Japanese?
To some extent, yes. But people have always joked there are 4 types of economy. There's emerging markets, developed markets, Argentina and Japan. It is an outlier. It's got a huge amount of debt, 250% debt to GDP. So 2.5 times what the UK has. No one owns its debt other than itself. It's kind of a circular thing. It's got a high level of societal coherence.
Yep.
So its population is kind of content and doesn't have some of the populist pressures that other places do. I'm sure they're there, but not to the same degree. Low levels of unemployment. Actually, its economy's started to do better than many areas of the world now. That's meant that the Bank of Japan has started raising interest rates. Inflation is a bit higher than it's been, and there is a bit more optimism. If you look at one thing's Abe, the late Prime Minister of Japan, who was assassinated, I think, last year after he left office, but he had 3 arrows of getting Japan going again. And one of those was monetary policy, one of those was fiscal policy, but the other was structural reform. And he did things like increasing female labour force participation. There are things to be optimistic about with Japan.
It does represent an imbalance. They might own their own bonds, but they also own quite a lot of US treasuries and I believe French bonds.
The biggest holder. They're the biggest non-US holder of US treasuries.
And I also believe French bonds as well, which I found quite interesting. And there's this carry trade, which feels a bit toxic to an outsider. Should we be worried about the unwinding of the carry trade?
Possibly. Not to keep going on about Trussonomics, but if you look at what happened there, if it hadn't been for some market technicals, they might have got away with it. You know, the fact that pension fund, LDI...
The LDI thing, yeah.
There was a market technical around hedging of overseas bonds and ownership of long-dated swaps. Both of those things, you saw a rise in bond yields as a result of Trussonomics and a weakening of sterling as a result of Trussonomics. Both of those things led to big collateral calls. It wasn't that the pension funds' assets had gone bad, but, you know, they were fine, but there was a collateral need for them to pay some money to people given to market losses. And that triggered selling, that triggered more selling. And so, as I said earlier, you know, that's one thing's fascinating about bond markets. It's not just the interest rates and the economics, but it's also thinking about where might these technical weaknesses, where might the forced sellers of something emerge or the melt up forced buyers. And there is obviously some attractiveness for Japanese investors to repatriate now. We've not seen it really. I mean, people said to me for a long time when Japanese 30-year government bond yields, JGB bond yields got above 2%, you'd see all the life companies in Japan buy long-dated Japanese bonds. Well, you know, today we're at 226 and it got from 2 to 226 pretty easily without any of this huge wall of money issue. Okay. So there's a mixture of myth and reality goes on with all of these things. You never quite know where these weaknesses might be.
How's your world of bonds changed since you began your career? What are the main things that are different today?
Bond yields were up at 6 something and they got down to minus something at one point, you know, so there's been this long decline in bond yields, which central banks took some of the credit for, too much of the credit. That's why they got beaten up. When inflation went in the other direction, they'd taken so much of the credit for inflation being under control that they couldn't really walk away and say, it's not me, Gov, when inflation went up. In both cases, it wasn't, you know, the thing that drove inflation down over my career was falling global goods prices, thanks to China joining the WTO, thanks to a healthy demographic working age population cohort. You know, if you look back to the 70s, there was a shortage of labour. Everyone was in a trade union. And then the baby boomers started coming into the workforce. By the time you reached the 80s and 90s and 2000s, that was their most productive period. They're all in the workforce. So lots and lots of workers keeping wages low in a non-unionized world. You know, there were lots of other factors that drove inflation down. Those trends have been really interesting. I guess going forwards though, or as I am now, the baby boomers are retiring.
Yep.
So we're talking about labour shortages again. Brexit being one of the factors there in the UK, but general declining globalization, still not to worrying levels, but to levels that it's no longer a tailwind for low inflation, low bonds. It's a mild headwind for them. And so that's been a recent change that we've kind of reached peak boomer and the boomers are now leaving the workforce in a less globalized world. And so that's the most recent development, I think.
Yeah, that's interesting because I think the other factor that happened in that period, a 40-year bull market for bonds or declining interest rates and absent inflation, was the advent of the internet and technology. So it doesn't look like we're going to get another China joining the WTO to help us along. And in fact, if anything, that trend has played out. But technology
Are you going to say AI in a minute, aren't you?
Yeah, well, but technology is trundling on.
Yeah.
And
Yeah,
I don't know. NVIDIA to me looks like Cisco when Cisco was the world's largest company in 1999 for about 10 minutes. I mean, it's still a very decent sized business, but it's a bit like Japan. It's only just reached the valuation it had in 1999. NVIDIA could repeat that trick, but it didn't stop the internet changing our lives.
I agree. It could be really interesting, both a threat and an opportunity. Up to now, technology has generally taken less skilled work, whether it's been robots in car factories taking those jobs. But this is AI, and recent developments will be the first time that technology will threaten middle and high earning jobs, as well as jobs in a legal profession, jobs in X, Y, and Z.
Managing bond funds?
Yeah, managing bond funds. Do we really need you as a podcast host, or could we have a chatbot doing it? The next thing for people to worry about is actually, could we have a world where there are no well-paid jobs anymore, and it will just be these evil capitalists sitting on top of their towers, owning everything, and there being nothing left for anybody? I'm a techno-optimist, I think, on this all. And, how quickly did we come up with a vaccine for COVID? And we've got avian flu out there now. We face existential threats all the time as a species, and any help we can get is going to be very welcome. Spotting threats from outer space, I don't mean aliens, but whatever it may be, helping with health issues more generally, it's good news.
Well, you've just got to cast your eye back to the last 200 or 300 years of human history. It's hard not to be optimistic. There are the forces of entropy, and mainstream media can drag you down every now and again. What might surprise us about your world of bonds, say, for the rest of this year and next?
I guess the biggest surprise of bond markets would be if inflation didn't behave itself and come back to target. If we ended up with more supply disruptions somehow, more geopolitics, all of those sorts of things ploughed on top of tariffs and so forth in the US, and suddenly in a year's time inflation's back at 4, and that would be extremely damaging for bonds, and I would say probably all asset classes.
All financial assets, yeah.
One thing we haven't talked about is that I'm not being facetious when I say bonds are really important and more important than equities. But, when you think about an equity valuation, you are simply, there's more to it than this, of course, but, you are looking at its future cash flows and discounting them by your long-dated bond yield. So if your long-dated bond yield is higher, your future equity cash flows are worth less and your equity is worth less. And so a steep rise in bond yields once more wouldn't necessarily be good for equity markets, even in a world where Trump is talking about tax cuts and growth and so forth. So it is important for the asset valuations we see around the world, whether that's credit or government bonds or whatever, that inflation does come back under control.
It's under control, yeah.
So that, to me, would be the big issue.
The point you make is absolutely valid, and one of the main reasons I wanted to have this chat with you today, because if, as equity investors, one didn't understand the relationship between long-term bonds and equities, you certainly found out the hard way in 2022.
Yeah, agreed.
Jim, that's great. Thank you for your time. Really appreciated getting your update on your world of bonds. I'm a bit of a podcast fiend. I subscribe to far too many, and there are some that I hardly ever listen to. When yours comes up, it's 10 minutes. It's done very well. It's very informative and entertaining. And I always find it's 10 minutes well spent. So thank you for doing that. And thank you for having the chat with us today.
Thanks for the kind words, and enjoyed the chat.